Hello and welcome to this week's Market Outlook. This is Jeff Fish, president of MarketGauge.com, and I am filling in for Keith this week. All right, so let's take a look at the markets from the standpoint of which way we should anticipate they're going to go next. I'm going to take a look at the Market Watch. I'm going to take a look at the market internals as we usually do. And I'm going to make this week's presentation pretty concise because I think it's really straightforward. Now, if I can get the pen to work here. Okay. When I say it's really straightforward, I think all we really have to focus on is the fact that the markets have been consolidating in a really relatively tight range now for plenty of time when we look at the Dow, SPYs, and the Qs. Now the IWMs don't have quite as easily defined consolidation because it's wider, but for all intents and purposes it's actually bigger, and I would draw it like this, and wider, but it's the same problem. The problem is that the market's going sideways, and this particular problem, at least for trend traders right now, was really highlighted by the fact that we had employment numbers on Friday and they failed to move the market. Now, this isn't necessarily a bad thing. It is, however, indicative of a market that's just kind of dug in, not really sure which way it's going to go. And the overriding theme here, which I'm going to lay out over the next several minutes, is that while the market's going sideways, there are signs that it's actually deteriorating internally. Now, that doesn't mean that it has to break down, but it does mean that we should be really cognizant and careful of the fact that it could. So the key levels to watch, as I've just erased them, are the lows of the ranges. Until we break the lows of the ranges, as bearish as what I'm about to portray may sound to some people, you can't expect that the market's going to go down just because the internals are falling apart. Falling apart is probably a little aggressive, but the internals are deteriorating. However, when the internals are deteriorating, you don't want to be too aggressive when the markets start to break down. Now, in my videos that I do during the week to members, my focus point of the point where we really have to get nervous is this low in here. So until we break that low in a convincing way, I don't think that we need to have an extremely bearish posture. But as we sit and consolidate here, there's good reason to believe that we should start to get conservative or defensive. And I'm not the only one saying this. In fact, the market is actually doing it on its own. So let's take a look at our site, our little Big View site. As you know, or should know, all this stuff is available for free. So let's just take a look at what it's doing for you right now. So the first place I want to draw your attention to is the accumulation distribution table. And you can see that the distribution days here are really lopsided, or the accumulation distribution really lopsided towards the distribution days. So even though we're going sideways, this is telling you that when the market goes down, we're having more days when it goes down on up volume than we're having on days that go up on greater than average volume. It's not necessarily a timing mechanism that will time it to the day, but it is telling you exactly what I've just said, which is that there's deterioration while we have this consolidation. So let's take a look at the sectors, the next move over. And this is an area where I think you really have to pay a lot of attention to. And the reason is because we've got a couple of important sectors that are bordering on some pretty dangerous levels. So the year-to-date number is a number that I would really pay attention to closely, especially in the areas or in the industry groups that have been strong this year or strong since the election. And that's the key difference here. Is the XLFs or the financials really took off after the election. However, recently not only have they gone sideways, but the last 3 months they're down. And if they turn down on the year, that's not going to be very encouraging. Well, they're only up 1.2% for the year, so it's not going to take very much for them to turn down. Again, I don't anticipate that that's has to happen, but it's close to happening. And the other area that's dangerous that we don't want to see turn negative is the transportation. And that too is really close to year to date. So this is a really simple way during the week you can keep an eye on this table. And it's not that as soon as these go red, you should pull the fire alarm, but you definitely want to be cognizant of the fact that if the market does start to sell off and the financials and the transportation start to lead on the way down, that's a big negative. The other area that this table really does a great job at illuminating is the strongest groups. So the strongest groups are the ones that you want to be focused on to lead the market. Semiconductors is obviously on multiple time frames one of the stronger groups and should be leading the market. So if we find days where the markets are down, you want to come here and see if the semiconductors were down more or less than the market. Is this semiconductor lead that it's got holding up, or is it deteriorating? We don't want to see it deteriorating. Now, the other thing that you may want to take a look at is XRT. Now, at the end of this video, I'm actually going to point you to another video that I have done over the weekend, and that'll give you more insight into why I think you should focus on XRT. I'm not trying to be coy here, just not going to cover, I don't want to cover too much in this video, but in short, what is interesting in terms of the market here is that XRT may actually be in a position to start to rally. Now that would represent a rather interesting industry group rotation. If we were to see semiconductors start to pull back and XRTs start to rally, that might represent what we've seen so many times in this bull market, which is just a rotation from one industry group to the other that keeps this market positive. So even though XRT is negative, it's in the dumps right now, it's sitting right on some important support levels, and if it starts to turn up in a choppy market, that could be a demonstration of the fact that the bulls are still alive, they're just not buying the strength. All right, but once again, keep an eye on that year-to-date level. We don't want too many of these groups going negative. That would be a really bearish sign for the market overall. So then let's take a look at the market internals. Now, I love these charts, but I don't love to overanalyze them. And this week is a perfect example of that. I like to see all these charts, 2 out of these 3 charts on the bottom, up-down volume, McClellan, and advanced declines over 10 days. I like to see 2 out of 3 of them in either an extremely bullish, or I should say extremely overbought, or extremely oversold zone. And I like to see that happening where you've got the market action going in the same direction of either moving up or moving down. And that's the easy interpretation of this. When you've got situations where the price is going up and you've got 2 out of the 3 over their threshold, then as soon as the market starts to sell off, you know that it was a little overbought, or on the flip side, oversold, and you can play that. But right now, we're in the middle of nowhere. Don't overanalyze it. I don't think it's really given us a whole lot of insight. That's New York, and if we take a look at NASDAQ, you have the same issue. It's really not indicating anything worth paying a lot of attention to. However, if we get to the new high, new low evaluation, a little bit of a different story. So when we're going sideways, we're still relatively close to the market highs. We really should see if the markets break out to the top or through the top of this consolidation, we should see this new high number explode over 100. Now we're still going sideways, so it's okay that it's kind of muted here. What we don't want to see is the new lows number down here start to expand. That would be negative. All right, this aggregation over the 10 days is still going in a positive way, so all's good there. However, the one thing to watch out for over the coming week is that if this breaks out to the upside, you want to see this individual number break out over 100 as well. If it doesn't, and we just don't have as many stocks pushing the market higher as we'd like to see. If it breaks to the downside and the new lows really swell, that's really negative. Now, if I take the same chart, look at it on the NASDAQ, it's the same thing, only a little bit more precarious. You can see that the new lows have begun to kind of creep up. It's not a dangerously high number yet, but what it does suggest at, the Qs here made an all-time high in the middle of the week. And new highs, as you can see, if you compare where they are here versus where they were over here, are really muted. That is not what you want to see on a new high in the market. So when I say that the market is deteriorating, these are some of the signs that I'm talking about. Now, the fact that this is under the 70 level is indicative of the fact that the trend is not going our way. Notice how this one is not going up, whereas SPYs were, or New York was. So, again, if they turn down, if this turns down from here, this is dangerous, it's bearish, and this is why in the beginning of the video I said the market pulls back. This is not a pullback that you want to be quick to be a buyer of. All right, now in terms of the VIX and sentiment, it's been a no-brainer really that as soon as this thing gets to the top of the Bollinger Band, whatever excitement in the VIX exists is over. I'm not so sure that I would look at the VIX that way right now. I would look at the VIX. The black line here is the 200. Hasn't been able to get over the 200. It's been really compressed. It's now been over the 50 for a longer amount of time than we've seen in a very long time. So once again, if the market starts to sell off and VIX pops up over the 14 level, that's a big breakout in VIX. And while this has not been the right call for many, many months, maybe even longer than that, I think if the VIX pops out of these bands this time, it's time to really pay attention to it. Whether you're buying it or not is not as important as I wouldn't be a seller of it. All right, so that's why I think that the market is in a situation where you really don't want to be a buyer until you really are sure that it's flushed out those lows. It's deteriorating. It doesn't have to go lower. If it goes higher, I've just given you some of the key ingredients to look for to confirm that the higher move should continue. If you don't get those indications, then I would be even more cautious on any higher move. Now, I also said earlier in the video that there was another video. So I covered for Mish this weekend as well. And in covering for Mish, I created a video. And the video goes into the Modern Family, 6 different ETFs, and describes which of those ETFs have good momentum versus not so healthy momentum. And this is another way to look at the markets to figure out which way it might go. So I think this is a really helpful way to get a better sense on which areas of the market might rally, i.e. why I think XRT, just a heads up, why I also think IBB might be an interesting play right now, and why IYT, which I said for other reasons, is in a really dangerous spot. So this is free. If you don't already get Mish's Daily, definitely sign up here. Same thing with Market Outlook. And with that, hope this was helpful, and I will see you in the next video.